Good morning, everyone. Welcome to the first World Council of Experts Forum. Our topic for this morning is real estate financing and its role in the real estate crisis and opportunities. I'm going to ask, and I know it won't do any good, but if anyone in the back might want to move forward, it'll be a little easier for us to recognize you for questions and that sort of thing. We have an awfully big room and not such a big audience so far. I imagine people will be filtering in as they finish their coffee and the break. We have a very distinguished panel with us today. One of our panelists that shows up in the program, Rainer Lux, had problems with his flight arrangements and was not able to be with us. But we do have Nikolay, a late addition to our panel, which will provide us with a Russian perspective that we didn't originally have on our panel. My name is Terry Dunkin. I'm president of the new World Council of Experts. I am managing director of Grubb & Ellis Landauer Valuation and Advisory Services in Baltimore, Maryland, in the U.S. We have our panel is a mix of bankers and valuers. Our first speaker for this morning is Wolfgang Kaelberer. He will address Basel III, property valuation and qualification for valuers. Wolfgang is the German Mortgage Bank's representative to the European Union and also serves on the board of directors of TGOVA, the European Group of Valuers Associations. The format for today's panel discussion is that each of the presenters will give a brief presentation on the topic that we have for this morning, and when we're finished, we will open it up for discussion and questions. I would ask that if you have questions during the presentations, if you hold those questions until we're finished, because I think it would be helpful to hear the presentations from all the presenters before we get into a discussion situation. And with that, I will turn the mic over to Wolfgang.
Yeah, ladies and gentlemen, I'm delighted to start this panel. I'm representative of the German mortgage bankers industry, and we have very strong interests in reliable property valuation. And this is what I wanted to present today. And I'm covering also the piece of Rainer, who is not attending today, on certification. So it is a short insight into real estate finance under Basel, the value at risk approach, how we conceive it from a lender's perspective, and the certification of valuers. It is important to remember that from our perspective, property valuation serves as a security tool. We value property not for transaction purposes, but for lending purposes. And that is a small difference in the sense that the property must be worthwhile as a security over the long term. So it must serve, it must cover banks' exposures over 20 years, 25 years, 30 years. And it is, I think, a difference compared to an approach where property is valued for transaction purposes. To start with, I wanted to show you the magic formula of the Basel framework. It is important to understand this formula. It is an equation where the total regulatory capital divided by risk-weighted assets must always be 8% at least. So Basel I, what is it? Basel I was a figure. It was 8%. That equation must always give 8%. That has been defined in 88. Then Basel II came in, defining what has to be understood as risk-weighted assets. Risk-weighted assets have been defined, or risk weights have been defined in Basel II in early 2000. And then came in Basel III, and that is the current stage. Basel III is defining the total regulatory capital, or reducing the capital definition to really core capital. So that's the whole secret. It is as simple as such. And the impact of this is very important if you look at comparative calculation between a corporate loan at the left and a residential mortgage loan at the right. If you have a corporate loan of $1 million, the bank has to allocate $80,000 to that loan. It's 100% risk weight. The same loan as a mortgage loan, the bank has to allocate only $28,000. So it is roughly 1/3 of a corporate loan. So there is a huge leverage effect behind this equation, which is the collateral. It shows how important the recognition of a collateral, of the mortgage collateral, is for banks. And mortgage collateral means a valuable mortgage collateral, and this means consistent valuation behind. And this has been recognized by Basel. The mortgage collateral is recognized as a credit risk mitigation tool. You will find in Basel, in the Basel Accord, this is the Basel II Accord, some rudimentary rules. I will call it rudimentary or principles-based rules regarding property valuation. It is strict valuation rules or some provisions regarding the assessment of the market value of the collateral. I don't read this slide. I just wanted to show where you can find property valuation rules in the Basel Accord. And there are further rules on definition and on monitoring and revaluation in the Basel II Accord. So at least a market value definition is provided, and there are provisions on monitoring and revaluation under certain conditions. And you will find a quite hidden reference to a qualified professional. The valuer must be qualified, and this is the criteria where we built on our qualification requirements. And at the end, this gives a quite nice picture where you can see the overall context, so the link between property valuation at the bottom. The left column is the asset side of the bank, where the bank has to allocate capital to the risks or to the exposures, basically for mortgage risk. And you have the liability side on the right side, where banks have to fund the business. And if they fund the business through covered bonds, there is another valuation issue at stake, because if you bring property values in the capital markets, and this is what happens there, then of course the property have to be valued on a reliable basis. So that's the context. There is a property valuation issue at stake for the asset as well as for the liability side of the bank. And in many European countries, property loans or mortgage loans are funded by the issue of covered bonds. There is the criteria of covered bonds, and you see that one of the eligibility criteria for properties to be eligible for covered bond issuance is conservative valuation. This is the liability side of the picture I showed the last slide. So, the Europeans at the very end said it is principles-based, it's fine. Basel Accord must be principles-based because it's a global accord applicable worldwide. We in Europe must be a bit more precise about this risk-sensitive valuation approach, and this is why mortgage lenders defined some more principles regarding this prudent approach. So, prudent assessment of the future marketability. Future marketability of the properties is important. No speculation, no speculative elements, normal market conditions, long-term sustainable aspects on the basis of the current use or alternative appropriate uses. From the perspective of a bank, alternative uses or marketability of the property is a crucial issue in the foreclosure process, for example. Transparent valuation methods and competent appraisers. This is the principles the lenders, mortgage lenders did define. And all this has been translated into European law because the European legislator said, oh, that makes sense. We draft a capital requirement directive in Europe where all these principles are included. So we have, beside the market value definition in the directive, a mortgage lending value definition, and we have precise requirements for qualification of valuers. And this has been complemented by a methodology of the mortgage lending value and by the certification of valuers, which we provide as an association for our members, but which many other countries also provide for their members, and I know which RICS, for example, is providing as well for their members. In order to be even more precise, what we are expecting valuers to deliver in their valuation reports, we defined 6 risk classes we are interested in and where we expect substance or information from valuers. There is the market risk bucket, the location risk bucket, construction-related property risks. This is where we wanted to get information about, or an assessment, tenant risk, fiscal risk, and legal risk. This is all what mortgage lenders are interested in. And if we go into the mortgage lending value methodology, we can see that we do not necessarily take market rental income. We take a net rental income which is sustainable over the long term. We deduct operational cost because operational cost is not available for clients to serve the debt. What is interesting mortgage lenders is what is at the very end available for serving the debt. And we apply a conservative capitalization rate which is also sustainable over the long term. How to do this? I think this picture shows the parameter of a sustainable rent. You see the channel, you see the black line. The black line is the rental development over 20 years, 15, 20 years, and you can derive, if you see this line, where the sustainable average is. And this is the basis for the calculation of the rental income of the property. So it is not a spot market approach. It is a figure which is derived from statistics over the long term. And of course, you must know those figures. Those figures must be available. And if you have a data bank where you can derive these figures, you are able to calculate the more sustainable value of the property. And this is a calculation example. I won't go into the detail. You can see that the annual gross income is reduced compared to the rental income of the market value. The difference is $308,000 against $394,000. And this is really what is remaining for the service of the debt. Then you have to deduct the maintenance cost, 15%. The average maintenance cost is between 10 and 15% of the building's income. So we deduct that from the rental income. We apply a more conservative capitalization rate, 6.5% against 7%, because over the long term, the property did not perform better than 6.5, although it might perform 7 for the moment, but it did not that on a long-term basis. And the mortgage lending value is then more or less $1 million below the market value, but that is the secure value over the long term. And this picture, I think, is showing this very transparently, where you have a volatile market value, you have a mortgage lending value which is much more stable. It might not be straight, but it is much more stable. And 6% of that value is the basis for putting property values on capital markets as a security for investors. So this slide shows a bit the behavior of covered bonds against other securities during the crisis. You see the blue line, which is quite close to the sovereign line, and this shows the resilience of covered bond funding and of conservative property values against crisis scenarios. And the lower chart shows that, for example, our covered bond is really very performing against other covered bonds because we have this lowest spread levels. The summary of this is, I think, easy to define. Value at risk is a core issue in banking supervision. It's a core issue for supervisors, and it is a core issue for credit institutions. And this materialized over the last 20 years since Basel rules, Basel #1 in the 90s. It is a prerequisite for sustainable or reliable values, is a prerequisite for lower risk weights, for lower funding costs, and we are very sensitive regarding the qualification of valuers providing this kind of values for us, and this is why we created a certification body in our country where all the banking associations are stakeholders, and we call it HÜBCERT, that's our daughter company, HÜBCERT certification, where we offer 4 different types of certificates for market value, for financial purposes, for mortgage lending value, and for standard properties. It is a 1-year course where valuers pass an examination at the end of that year, where then valuers are monitored and where then they have to be recertified after 5 years or every 5 years. And the prerequisite is university graduate, to be a university graduate, or to be a practitioner, but then with at least 8 years of professional practice. The exam is at the end of that year, consisting of 2 valuations, 1 plausibility check, and 1 questionnaire, written, and then oral exam at the end. Recertification at the end of the 5th year, and we can see it is a very strong requirement. It's a tough examination, but demand is very high. You see the curve. Many valuers, 1,200 valuers, did apply for this certification, and we have a cooperation agreement with the Appraisal Institute as well, where we exchange information and where we offer courses, and we even got recognition of TIGOVA, the European Federation of Valuation Associations, where the certificate has been recognized as complying with the TIGOVA's recognized European valuers scheme. So there is a European dimension which TIGOVA is offering for well-qualified valuers in Europe. So that's it. Thanks a lot for your attention. Risk sensitivity, valuation reliability, and high qualified professionals are at the core of our debates, and I'm happy to discuss that with you during this panel. Thank you.
Thank you, Wolfgang. Our next presenter is Michael Buchmeier, and Michael will be addressing regulatory standards, especially capital requirements and their influence on real estate. Michael is Managing Director at MRG Metzger in Vienna, Austria. Prior to joining MRG Metzger, he was 9 years in the banking business, and I will remind you that if you want more details on the background of any of the presenters, they are all in the program. With that, Michael?
Ladies and gentlemen, thank you, Terry, for the introduction. It's a great honor for me to speak to you today. For me, it's always exciting to stand in front of such a competent and interested audience. Today, I'm pleased to give you a brief overlook over the standard settings in Basel II and Basel III and their influence on financing of real estate projects. I would also give you some ideas of alternative financing structures. It is important to understand both regulations, Basel II and III, because Basel II concentrates on the asset of the bank balance sheet, whereas Basel III deals with the equity side. As we heard before, Basel II was established in 2007 and had a big influence on the banking landscape. For the first time, banks had worldwide standardized regulation. Basel II consists of three pillars, of three main pillars. I will explain to you the details of these three pillars. The first pillar deals with the maintenance of regulatory capital calculated for three major risks that a bank faces. First, credit risk. Second, operational risk. And third, market risk. The credit risk component can be calculated in three different ways, namely standardized approach, foundation IIB, advanced IIB. IIB stands for internal rating-based approach. For operational risk, there are also three different approaches: basic indicator approach, standardized approach, and the internal measurement approach. For the market risk, the preferred approach is value at risk. But coming back to the credit risk can be calculated by using one of the three approaches I mentioned before. The standardized approach sets out specific risk weights for certain types of credit risk. The standard risk weight categories are used under Basel I and are 0% for short-term government bonds, 20% for exposures to the OECD banks, and 35% for the residential mortgages, as we heard before, and 100% weighting on unsecured commercial loans. A new 150% rating comes in for borrowers with poor credit ratings. The minimum capital requirement, the percentage of risk-weighted assets to be held as capital, remains at 8%. For those banks that decide to adopt the standardized ratings approach will be forced to rely on the ratings generated by external agencies. Certain banks are developing their own IRB approach as a result. The second pillar deals with the regulatory response to the first pillar, giving regulators much more improved tools over those available to them under Basel I. It also provides a framework for dealing with all other risks a bank may face, such, for instance, systemic risk, pension risk, concentration risks, strategic risk, legal risk. It gives the banks the power to review their risk management systems. The aim of the third pillar is a disclosure requirement for banks to ensure transparency for market participants concerning the bank's risk position and to provide details of their risk management activities. When marketplace participants have a sufficient understanding of banks' activities, they are better able to distinguish between banking organizations they can rely on or not. Due to the financial crisis and the breakdown of established banks in US and Europe, new capital requirements were needed. The Basel Committee issued the Basel III rules text, which contains the details of global regulatory standards on bank capital requirement and liquidity. The framework sets out higher and better quality capital, better risk coverage, the introduction of a leverage ratio, measures to promote the build-up of capital that can be drawn down in periods of stress, and the introductions of global liquidity standards. The standards will be phased in gradually so that the banking sector can move to the higher capital and liquidity standards while supporting lending to the economy. The new standards are a bit more complicated than in Basel II, but also more intelligent and should be much more effective as well. Possibly the most important thing here is the setting of minimum standards of common equity, which is also known as core tier 1 capital. Such standards did exist in the past, but they were set extremely low at only 2%, and so were generally ignored. As of now, common equity is the main thing that matters. No more throwing any old garbage into the tier 1 bucket and calling it capital. The new standards for common equity are significantly tougher than the old standards of tier 1 capital in total. The absolute bare minimum of core tier 1 capital is 4.5%, and the new minimum of tier 1 capital in general has now been raised to 6%. You see this in the second column. The minimum for tier 1 remains at 8%. But on the top of that, there is a conservation buffer of another 2.5 percentage points. With this conservation buffer, then banks need 7% common equity, 8.5 tier 1, and 10.5 tier 2 capital. When credit in an economy is growing faster than the economy itself, a counter-cyclical capital buffer kicks in, which essentially says that banks need to have more capital in good times. This counter-cyclical buffer won't be set by Basel. It left be up to the national regulators. So when the economy is booming, banks are going to need 9.5 common equity, 11% tier 1, and 13% tier 2 capital. The Basel III rules, will it make it even harder for banks to lend money to real estate companies and investors? Some bankers claim that the measures will knock off 5% of global growth, and UBS recently estimates that banks may need to raise $375 billion globally to meet the new requirements. Due to the capital requirements to the European Union from October last year, whereas the core capital has to be increased from 8% to 9%, we have seen during the last months that banks were very restrictive with their lending policy. They concentrate on the fulfilling of these requirements. As the capital market does not work very proper, the challenge is much harder than banks had expected. Therefore, the lending policy, especially of the top banks, is very restrictive on the one hand, and on the other hand, they try to sell parts of their loans to investors to cut their balance sheet. But not only the lending policy is changing at the moment, also the majority of loans, especially the spreads for loans, are developing not in favor of potential debtors. The long-term financing of real estate will change. My experience is at the moment, especially at the Austrian market, that the tenor of so-called long-term financing does not exceed 10 years. Before the financial crisis, tenors of 15 to 20 years were accepted. What we also observed is that spreads doubled or even tripled during the last years due to the lack of confidence and between banks and the lack of liquidity. Another essential issue has to be mentioned. Since the financial and economic crisis, the ratios of loan to value have decreased clearly. In the years 2006 and 2007, the ratios were up to 90% and sometimes even higher. Nowadays, the LTV ratios were down at 50 to 60%. As a matter of fact, considerable more equity is required of the debtor. Based on all these components, Basel III, lack of liquidity, high spreads, more equity required, debtors have to look for new opportunities and alternative financing models and structures. Especially so-called hybrid financing structures are becoming more and more important. In the next few minutes, I will present some alternative financings. We heard some of them before. They are divided in equity financing, debt financing, mezzanine financing, and special forms of financing. The slide behind me gives an overview of all alternative financing structures in the real estate context. Alternative financing instruments are placed between equity and the classical bank loan. I picked some of them out to explain to you. For instance, joint venture financing. We speak of joint venture financing when the bank is granting the loan and participates at the same time directly with own capital and own equity at the investment. Therefore, the bank and the investor found a project cooperation called joint venture. Joint ventures are not a new finance instrument, but a hybrid of traditional loan financing and a stake of project partners. The main reason for joint ventures in project developments is that project developers are not able to allocate the required equity. The advantage for the bank is that they have better transparency and this lowers the risk. And on the other hand, the joint venture partner receives a higher interest margin due to the profit sharing. Real estate private equity. Real estate private equity is a tool to finance real estate operations of non-market listed companies with external funds on the equity side. The most of the real estate private equity corporations acquire capital via the real estate fund concepts. Another topic is the convertible mortgages. Mortgages are granted with an interest rate below the market interest rate because they have the possibility to convert the loan amount into an equity participation and then gain again the profit of the project. Participating mortgages are very similar with the difference that in the that they have a fixed cap profit stake of the real estate project is being granted in the contract. Sorry. Covered bonds. We heard a lot of covered bonds before, so I have not to go there in detail. Last but not least, real estate leasing. Leasing is a kind of debt financing. The main difference is that the leasing company, called lessor, is owner of the property and leases to the client, the lessee. Leasing is suitable for long-term financing. The advantage of the lessee is that in most cases the equity requirement is a little bit lower than in a classical loan financing. The advantage for the lessor is that he is owner of the property and he is able to sell the property in case of default immediately. All these financing alternatives can support the real estate industry to achieve their goals, growth and success. But it is essential that banks concentrate again on their origin role, lending money to the economy and support the ideas of their clients by granting loans to acceptable terms and conditions. Banks still have the most important role in the economic environment, and they therefore have to be aware of their role. I thank you very much for your attention.
Thank you, Michael. Our next presenter is Martin Bruehl. Martin will address property valuation in the aftermath of the financial meltdown. Martin is Managing Director of Cushman & Wakefield in Germany. He was also elected as Royal Institution of Chartered Surveyors Vice President. A more complete resume of Martin is included in the program. Martin.
Thank you, Thierry. Hello, everybody. I'm delighted to be here. How is everybody? The room is a bit dark, and we're just before the lunch break, so I thought I kind of do something for your blood sugar content and present you with a punchy, brief presentation. My starting point, really, ladies and gentlemen, is the fact that the structured debt and insurance products, which arguably have caused the financial crisis, which in turn has caused an economic global crisis, were all anchored against real estate property. And somebody must have valued that real estate. And a few of the valuers who were involved at the time were actually here today, and me included there. So I'd like to explore a bit what we have learned from all of what we've experienced the last few years when this asset price, property price bubble exploded, and suddenly these papers, these financial instruments, turned into something which Warren Buffett has so bluntly called financial weapons of mass destruction. I've got two additional points to what Terry just mentioned to say about me, if I may, at the beginning. Yes, I'm RICS Vice President. Yes, I run Cushman & Wakefield in Germany, but I'm very much a valuer by profession and a valuer by heart. And I'm also a German. And therefore, when I saw that cartoon, I just couldn't resist showing you this. I suppose because this is a joke in writing, I have to read it out, otherwise the simultaneous translator wouldn't translate it for you. It says, "The moment Angela Merkel lost all faith." Nothing against the Greek here. Angela Merkel wasn't the only one who lost all faith, I think. I think the financial markets are getting a bit confused, and I've not seen them, nobody of us has seen them so in a state of nervousness and almost panic than we have seen in the last few days. The fact that the Greek don't seem to be capable of forming a government has caused quite some shock around the world, and also the horror, or the dollar in horror expresses that. There is so much uncertainty about the future of the Eurozone, and that's going to continue well beyond, I suppose, the Greek elections, expressed by something quite mad. In the Eurozone, the German 10-year bond, the government bond called the Bund, had a yield yesterday of 1.4%. 1.4%. The spread to a 10-year Spanish euro-denominated bond was almost 5%, 5% risk premium for Spain. A Spanish 12-month bond cost 3%. A German 30-year bond, 30 years versus 12 months, you could buy at 2%. That goes to show how mad things are at the moment, and this uncertainty will continue, will of course have an impact on the way we look at property and the way we value property. Gold, by the way, no longer the safe haven. Gold has reached yesterday its lowest price since the beginning of the year and has started to show some very strange correlation with risky papers. This may not be a lasting effect, but that's something which I think is an example of how uncertain times have gotten. I don't want to bore you with long stories how this all began. I think we knew it. It's all down to the turkey. Remember the turkey? You know, that animal that is being fed for 1,000 days, for the first 999 days, you can see this on the graph. You know, I'm very scientific, so it's always a bit graph. The turkey thinks this is a great life. The human beings around me, they feed me, they're very nice to me. And this turkey extrapolates the experience of the first 999 days of his life into the future, and suddenly he wakes up one day when Thanksgiving is approaching, and he incurs a revision of belief. And I think we all have incurred a revision of belief, because what we called a paradigm change in the way assets are being priced, sometimes lower than risk-free premium in certain markets. When you look at Paris and London at the height of the bubble, I think we've all learned that paradigms don't change so easily. The pendulum since these days, in 2006, 2007, has swung back. And it has swung back in a few aspects. Securitization, you know, the off-balance sheet, shadow banking-like financing machinery has given way to balance sheet financing again, regulated balance sheets financing, as we've just heard from Michael and from Wolfgang, with Basel II, Basel III lurking, and the Pfandbrief refinancing, which was also addressed by Wolfgang previously. The second thing which has swung back is, the easy access to cheap capital, of course, has given way to what we all call a credit crunch. Confidence very much has moved over to uncertainty. The pendulum has swung back from, I want to buy half-empty properties because for example, in Germany, we had US investors, private equity investors, they wanted to buy not a stabilized core asset because they found that boring in 2007. Where's the upside? Where's the vacancy? That has now moved to uncertainty, to something which, further down below, I would now call the overpricing of risk rather than the underpricing at the time. The quick and dirty way of valuing drive-by property valuations have certainly given way to a due diligence approach and the standards which Wolfgang was also referring to. And something which is going to come back as a theme in my brief presentation is the move from a mark-to-market to a mark-to-model, which is, in a way, the Pfandbrief mortgage lending value approach, which has been referred to previously. Greed, which was very much the theme then, has given way to fear. And so how do we respond to all that, the pendulum having swung so much into the opposite direction? I think the only way to really approach this is change. We need change. I think somebody who ever heard that line before, we need change. Charles Darwin said that it's not the species the strongest that will survive, nor the most intelligent. It is that which is most responsive to change. And I think this is the important message. We need to change a few things to prevent these things from happening. I think this doesn't really need any translation, does it? Arguably, and I'm very much a believer of that, we in the real estate industry, no matter what exact sector we're dealing with, we were part of the problem, let's face it. But I think we can also very much be part of the solution. So whilst our fire engine may be burning, we can come to rescue. Let me just say a few words on how we at the RICS, at the Royal Institution, are trying to contribute to that sort of wind of change, that thought process, which leads to a different level of awareness, preventing, if possible, future asset price bubbles and crises like the one we haven't quite gone through yet to prevent from happening. Now, why do we exist, first of all? I mean, in short, the RICS, the Royal Institution of Chartered Surveyors, exists to advance and to enforce professional standards across land, property and construction. We are the largest global professional body for property professionals. We've got 180,000 members. They're working in 146 countries, and we are operating 43 offices around the globe. Our members are gathered in 17 groups of specialization, and within themselves have over 200 skill sets which we train and give guidance on. We really produce, as I said at the end here, property professionals. We do this by qualifying and regulating our network of members worldwide to a consistent standard. This is actually pretty important in the current marketplace, which is more than ever looking for consistency in delivery of services and competence of those people who provide these services around the globe. So when I was saying we produce professionals, that sounds a bit courageous. What does it actually mean? What's a professional? In our way of thinking, ladies and gentlemen, and that's important also when it comes to learning from the crisis, learning from what we've just been through, a professional isn't only somebody who knows his stuff, who's good at what he's doing. That's not a professional. A professional is somebody who, first of all, has to be qualified and comes within the institution meeting certain entry standards which are set and which are tested. Somebody who commits to a lifelong learning process thereafter, so his whole career he's going to demonstrate and give evidence of his continuing professional developments. Of course, he commits to abide by ethical rules and professional standards. Very altruistically, but that's actually true. We require this, our members, to do. He puts the interest of customers, of the broader public, ahead of his personal gain, and he's prepared. This is very important because our RCS are a self-regulating body to undergo external scrutiny. Not only do we set standards, our RCS are enforcing standards, and although I don't really like the word, but I say it anyway, there is policing. There is policing around within our RCS, people going to see somebody in their offices, checking whether they are properly insured, whether they keep their files in order, and whether they meet the standards of code of conduct and of the profession at large. That's what we call a professional, and we produce them. Currently 180,000. Now, we're trying, and it's a constant process, ladies and gentlemen, of course, to find the right approach, the right response to what has happened. And this is really the challenge for all of us in the property profession, and particularly the property valuation profession, because as I said, these anchors of real estate, which form the basis of these structured financial debt and insurance papers, CDOs and what have you, they were valued, and they were valued in rising markets, and something happened when the bubble exploded. We're looking for the next level of regulation, therefore. We need to improve always. And we're in a campaign for confidence and trust of all the major stakeholders around the world. And there's one important element, I think, which we've also introduced recently, I'll come back to this in a second, is we would like our members, when they give valuation advice, to be clear on the level of valuation certainty. Funnily enough, we had guidance notes published recently which were called Guidance on Valuation Uncertainty. We're, after all, a bit in marketing and think that we shouldn't really be overly negative and critical about ourselves. So we now give guidance and become clear on the level of certainty and reliability of our valuations. In a way, it's an approach of self-regulation reloaded. We would like to reach the next level of self-regulation. Of course, we look constantly at the entry routes which we provide for people to come from the profession into our professional body. We have something which I'm not going to touch about given the time constraints, which is called firm regulation. We regulate firms, not only individuals. But there's something which I would like to touch on, which is the new Red Book, which is the standards of valuation which we publish, and a scheme which we call the Valuer Registration Scheme. Now, some of you may have seen this at least color-wise. It's the International Valuation Standards. Why do we need global valuation standards? I think this goes without saying, especially at a FIABCI conference. Values supply to global clients, banks, investment funds, corporate entities. They all are, most of them are global entities, and therefore would like to have one consistent standard worldwide, wherever they operate. And real estate is a global industry. Did you know that around 70%, UN statistics, around 70% of the global wealth is in real estate, 10% of the workforce of a developed country work in real estate. 40% of carbon emissions, the carbon footprint, is from heating and servicing buildings, and 60% of all materials go into building and the real estate sector. So this is a global industry and a very important one. And although national boundaries may result into different variations occasionally, there are a few basic rules of engagement which apply, and the international valuation standards, here highlighted to the left, they set the broad framework of that. But here comes the crunch. Of course, they're there to build trust and public confidence in valuation services and valuation altogether. But the missing link, we believe, from a rather top-level, high-level international valuation set of standards is done by the so-called Red Book of the RICS. The IVSC, as I said before, sets out to govern the basic principles, the high-level principles of valuation, but when it comes to actually applying them in day-to-day business, in the day-to-day work of everybody, of our members, we would like them to be spot on and perfectly prepared to provide global standards and a comparable level of quality around the world. The IVS, International Valuation Standards, by the way, 2011, which have come into effect on the 1st of January 2012, now also deal with other assets than just property. They refer to assets and liabilities. So we're talking about also some recognition of the fact that some of the deleveraging which has to go on around the world in the future will be dealing with liabilities and the collateral behind these liabilities. Now the new Red Book issued in March 2012 really is fully compliant with international valuation standards, giving guidance on the micro level for our members. And that leads to clarity and transparency. And the adoption of IVS for RICS was a big step. We helped to set up the International Valuation Standards Council many years ago, but we would like to stop the fragmentation of standards. So we adopt them and give our members guidance as to how to apply them. And just to finish this off, the RICS Red Book purpose, therefore, is to provide an effective framework within our rules, our strict rules of conduct for the users of valuation services, that they can have confidence in what a chartered surveyor produces is in full compliance with the international valuation standards. It really regulates on a lower level the high-level concepts for practical day-to-day application. The other element I was briefly touching on, something we've learned, something which is a sign of how we respond to the crisis, which was real estate anchored, as we have heard before, is the so-called Valuer Registration Scheme. Out of the 180,000 members of RICS, roughly 110 are fully qualified members. The rest are students and people who are about to become trainees, who are about to become members, and we convert them quite reliably. Out of the 110,000 full members, 40,000 are valuers, are members of the professional group of valuation. We would like to make sure that RICS valuations remain the global gold standard. Therefore, we have tackled the 40,000 members and have made them undergo a special application process. They already are chartered surveyors. They already have gone through that element of entry-level documentation and demonstration. They also have committed themselves to lifelong learning, this continuing professional development, and yet we want them, now that the world is looking at those guys who have valued real estate, which formed the anchor for the financial products, that they have another level of regulation on top of them. So we're getting stricter. There's going to be more policing. There's going to be more scrutiny applied to those members of RICS who are valuing. We want to increase the public protection. We want to demonstrate that we have a robust self-regulating system in place. We want to underpin confidence, of course, also of governments, banks, and regulators. We would like to remain self-regulating as a professional body and don't really like state intervention that much. This works certainly in the United Kingdom, but also in other countries where we're expanding globally. We really want to improve our internal regulation to protect and improve the perception of valuers in the eyes of the regulators and those those who use valuations. That is really two elements: the new Red Book adopting international valuation standards and our internal value registration scheme, which I would like just to show how the professional body can evolve and learn from the things which have happened. Now, I don't know whether this needs translation. Professor Sapitsky proved that the squid, you know the squid, is more intelligent than the house cat when posed with puzzles under similar conditions. So far goes the research. It's a bit too close for you guys at the panel, I'm afraid. So what does this all mean for the art and science of property valuation? Remember, I'm a valuer at heart. A few thoughts, if I may. A few thoughts just before I close of what can change. The role of the valuer. Question. Don't know whether you want to raise hands or maybe address this in the question round afterwards. Is the valuer a scorekeeper, somebody who just counts the scores, counts the points the team makes, or is he a referee, somebody who steps into the interaction of both buyer, seller, the protagonist, the financing parties? The conclusion we have drawn from all this is it's got to be both. You've got to be observing the market, depicting pricing mechanisms, but you also at some point in time just can't simply extrapolate a trend, otherwise you become a turkey. The pricing of risk, the challenge, up and downside risks, is something which we have to revisit. My personal theory is that the pendulum has swung far too much into the opposite direction. Today we are seeing investment activity in the very core element, the core spot of the market. And I have the theory that certain markets where core assets are being bought are getting so overweight with capital that even the core stuff, the alleged secure stuff, becomes risky, because the day the capital moves elsewhere, this was proved to be overpriced. So careful with the underpricing of risk or the overpricing. We can stick to the three universal columns and pillars, rather, of valuation: comparison, cost, and income. But maybe clever combinations of those would help, not just relying on one method. And I think we can learn a bit, forgive me if I say so, but I'm speaking as global vice president, we can learn a bit from the Germans who combine, especially in the Pfandbrief arena, who combine these methods quite ably. The valuation advice these days doesn't mean give me a figure. Some people just don't want to just have the figure. They want to know, okay, what's it worth and what can I do with this property? So I think we need to change also the approach and become valuation advisors rather than just valuers giving spot figures. This, of course, is something which can only work if we stop the commoditization and the erosion of valuation fees, which we've seen in Europe to a dramatic extent. We've actually caught up with you Americans, Terry, in that respect, where fee erosion, commoditization was something which was the case many, many years earlier. Now I think we need to turn this around and actually do some product differentiation to bring the valuation value added back to where it actually should be. And I think we should think, at least in certain aspects, in certain instances, whether we could bolt onto a mark-to-market approach, something like a mark-to-model, to be a bit more risk-averse, a bit more prudent. And I think, and I'm just going to mention this briefly, Wolfgang Kaelberer has already done this beautifully, the mortgage lending value, something which many people outside of Germany or outside of Europe think it's a bit weird, it's a weird risk management concept. It's actually quite an interesting thing, and you've seen that graph before just half an hour ago. If the starting point is a mark-to-market market value, mark-to-market, but then applying certain risk management techniques, you can still do this as a value. It's a product. Yeah? It's something which, as we've heard, banks need, and banks need to a certain standard which is also uniform around the world. I think we should open ourselves. This is also part of our evolvement, our evolution in the aftermath of the crisis. Now the pendulum has swung back. It will swing. It will continue to swing. I think, ladies and gentlemen, now is time to prove ourselves. To prove ourselves as professional bodies, to the world, to the regulators, to governments who are confused. Let's stop being fragmented. Let's unite and continue on that path of harmonization and alignment, which I think we've done so well, and FIABCI is doing a fantastic job globally there for many years already. But this is the time to prove. Let's stop confusing the stakeholders, the users of what we do. Let's align, let's harmonize, and let's adopt, as we have done as RICS, adopt international valuation standards. As valuers, I think it's time to prove ourselves. again, I'm a valuer, it takes so little skill to just gently extrapolate a trend which is well established, like upwards or downwards into the future, and to do this on the back of a lorry load of comparable transactions. That's easy. In the absence of such liquid market, I think this is where skill and art of valuation really starts. Some people have blamed me and my colleagues for valuing on sentiment. So what? Even the absence of comparable evidence is market evidence. And prices are being formed with the sentiment of both buyers, vendors, and even banks attached to them. So I'm a believer in you can value in difficult times on sentiment. If you do, the last point, if you step back from what you've done, what you've calculated, because you can't calculate market value, you have to understand how pricing mechanisms work, how the market functions, and if fear and greed swing around like this, you've got to understand greed and fear. And then you can value real estate. That's, I think, what we can all learn from this. So then, if this all comes true, and if we all stick to this, a brave new world is ahead of us. This is something I picked up at MIPIM in March. In 2009, MIPIM, the International Property Conference in Cannes, we drank gin and panic. For some, a year later, in 2010, the glass was half empty. A year later, for some, already the glass was half full. Last March, not everybody drank champagne, but quite a few. I actually had tea. And there's quite a few already look forward to the pendulum swinging further and look forward to somebody buying and lending for the next bottle. So I've reached the end of it. I've just got one last thing, maybe some food for thought, especially after the situation I explained with Angela and the dollar in horror. I would like to share with you the joke of the month. Are you ready? You ready? Yeah? I'm still on time, Terry, yeah? And that's risk-free rate of return. Thank you very much indeed, and look forward to your questions.
Thank you, Martin. Our next presenter is Nikolay Kazansky. Nikolay is he's with Colliers International here in St. Petersburg and has been for a number of years. Has played various roles, including a valuer here. Nikolay is currently the managing director of the Colliers International office here in St. Petersburg. Nikolay will address real estate financing and valuation from a more local perspective here in Russia. Nikolay.
Thank you. Hello, everybody. Originally, I was going to speak Russian to meet the demand of Russian-speaking people, but can I just check how many Russians are here? Можно поднять руку те, кто по-русски говорит?
Please raise your hands, those who speak Russian.
So we have about 1/4 of Russians, so probably... And who speak English? Can you put your hands up? Okay, I'll speak English, but I hope everybody has translator. Probably somebody speak another languages. Put your hand up as well, just for our research. Okay. So we had really interesting presentations here, and now, sorry, I don't have slides, PowerPoint slides, but I think I'll talk more about how, from our point of view, which problems or challenges we are facing here in Russia, in St. Petersburg, and what as well we can see how to manage the risks, not from valuator, but probably more from manager or broker or developer side. And what is going on that actually, like Martin told, really great point to survive is to follow the changes. We here in Russia is really changing every year for last lots of years. So we have this experience, but that doesn't mean that we are not facing lots of, say, questions and challenges after last crisis. And what I would like to say main is that it's a gap of professionalism. So what we need to have more is more responsibility, more personal responsibility of people, of professionals regarding their decisions banks, developers, other players. I can give you one example. For example, it's about valuation point of view. We had three same land plots, more or less same. So I mean, it's one embankment, so it's like similar locations, but the deals were closed in different years. In the year 2000, about 2 hectares of land were sold with a price of about $1 million. In the year 2005, same size, close location, were sold with a price of $15 million, so 15 times higher. But then in the year 2007, we closed a deal for our client with a similar location and similar size with a price of $53 million. So you can see that in 7 years, same land plot changed, priced 53 times. And then if you look to, let's say, valuation report, this way, it really depends on date. But then after, let's say, now I would like to say that current price will be about 20-25 million, let's say. So it's really changing. And lots of depends of how you are managing these changes and challenges. And for example, if you are buying this land or this property, if you are paying everything in one time, it means that you already froze all your money here. And probably then you can face, if you will face changes, you can, and it will be, let's say, not growth, but some going down of the economy, it will be difficult for you to start this development project. So how we are working with this right now, we just structuring the deals, we are advising to structure the deals the way when you are not paying everything, probably something depends on future results. So it's not only a question of valuation, it's a question how you'll manage it later. And with this example, you can see that every time, especially when the economy and the market is not stable, is still growing, you can't blame valuators because the price was okay, but for this exact date, then it changed. The other questions which we are facing here is short-term securities which you can get for your project. For example, rental securities. When you are getting tenants to a project, typical rent is not long, so you can't guarantee your income. And same time, probably main question for developers is financing. And that's what we are discussing now. But what's the problem, what's the question here in Russia? Really often you are getting such, from one side, high interest rates, and from other side, short-term credit, so you are getting negative leverage to your project. And this way, if, for example, our cap rates, our yields are about more or less 10%, if you are getting credit with, let's say, 11 or 12%, it's not work for this project. So it means it should be cheaper money and it should be longer terms, especially for development. Because you know that crises, we have not only global crises, we have sometimes some real estate changes on real estate market. It depends on supply, demand, other factors. And finally, you can get, if you are getting, let's say, credit to 5 or 7 years for development project, it's high probability that you will face that crisis, especially if you don't have long-term finances. So after this, projects can go to banks. But what we saw last 4 years, and we were expecting this not only in Russia or Europe, but all over the world, that it will be a number of distressed asset sales, and then we didn't meet it, actually, because majority of the banks decided not to show their losers and just to fix and manage situation in their way. And probably it were good for shareholders, but sometimes it was not such good for market, because sometimes we need to change developers. Best cases we have here in Russia, we saw with the changing of landlords where some, let's say, projects changed their owners, their shareholders, and finally they got to completely new wave of approaches of management, let's say after crisis approaches. So credits, rental agreements, and is main 2 points for the local market. As well, I would like to say that residential projects, they're a little bit different because they are quite often, especially in Russia, financing from the sales of potential flats under the stage of construction. So in this way, you don't need too much banking financing. It's both banking financing and this money from flat sales, but same time, it's still depends on demand for this. So what we can advise for developers, for investors, for landlords is to have committed credits, is to have right structure of your deal, not to pay everything 100% in one day or even in one probably year. Sometimes if it's development, it can be structured for long term. And to be professional, to have right property or right project in right place, and to do everything correctly. Because otherwise, now we are facing that we don't have here the problem of demand. It is lots of demand for good properties, for contemporary properties. We still don't have too much supply. We are not oversupplied here in Russia. So it is not same questions like in Europe, in Western Europe especially, but same time we have problems with financial solutions for development. So demand is blocked with these blocks. And what we can do is just to think more about how to catalyze this development and how to meet this demand and get it profitable for everybody. I think now I'll finish my brief speech, and I'll be happy to answer your questions, please, regarding local market and global questions as well. Thank you very much.
Thank you, Nikolay. That concludes the formal presentations, but we do have time and would like to open the panel to questions from the audience. Robert.
I don't have a mic, so I'll find it.
That's coming.
Thank you. This is to the Wolfgang and also to the other Michael, to the German speaker. In Basel, you talk about the marking to market or as situations change to revalue the property. Is that decision triggered by specific events, or is it up to each lending institution to determine when they feel they should revalue the situation? And secondarily to that is how important in all of the arithmetical calculations and modeling is what I'll call tenant quality, because many people are forced into making poor decisions because the short-term reward is so great when in essence they should make long-term decisions, but they can't because the banks don't provide significantly long-term financing. So that while I may desire to have a tenant that will sustain his rent-paying capability over a long period of time, but pay me less initially, if I go to the bank with those figures, they say, well, we can't loan you but X amount of money. Whereas if I come in with short-term loans at high rates, which have no future surety whatsoever, they'll give me more money because it looks better in the short run.
Yes, if I may start. The revaluation issue is pretty much a banking supervisory subject, and Basel is only providing the principle that revaluation has to be done when market change significantly. So what does this mean? A significant change in market conditions has to be interpreted by supervisors and bank internal guidelines. So this is pretty much an issue where the national supervisors have to come in and define what does it mean. For example, in my country, it is 10% market volatility. If prices go down more than 10%, the banks have to review the valuations. There is a 10% requirement for commercial property and a 15% requirement for residential property. So it is defined by national supervisors. Regarding the second question, it is pretty much lending policy, where, of course, short-term leases with high rents or do produce a coverage ratio of the loan, but which is not, I may use the word sustainable over the long term. And that's a problem, of course. And as the loan is going to be repaid not only over the first 5 years, but over 20, 25 years, there is a gap. And this has an impact on the property value, because this risk is priced in the value of the property, but that is pretty much banking policy, risk policy of banks, and this is scrutinized by banking supervisors. There is no general rule how to deal with these transactions, but this is risk sensitivities where supervisors have a look at.
Basically, I agree, of course, with Wolfgang. To say some words about the revaluation, I think there is no basic rule in Basel III or 2 or 3. That's absolutely correct, and I think it's. But I think it is a very important issue to make these revaluations, because markets are changing so quickly at the moment. And sometimes there are different qualities in revaluation. So we have where we say if there is a big change in the market or in the project itself, then there is a complete report necessary. If this is not, we can just go in on some details and make a small update to the full report from the last year. So I think it is for banks and also for the client very necessary and very important to make such revaluations. And your questions concerning the rental agreements. I agree with you. So there is, I think, short-term rental agreements with high rents not always show the real value of the property. So the valuer has the exercise to see the value of in the long-term run, not only for the 5 years or 3 years. So this then they can calculate, is this for the 3 years the market value, market rent or not, and then this thing is to go in the valuation.
I think judging the risk should always be up to the bankers. They're pointing more and more towards the valuers, towards us. And it's their job to rate the risk, because we cannot, even with a red book, we cannot make a 20-year evaluation. We give them a moment's exposure, and we can say, in our view, the development will be such, but they should never point at us. That there's no validation date in our appraisals, and even a mortgage value appraisal is nothing more than an approach. You might as well take 50% from a market value. That's also an approach. What I'm saying is that we're just the provider of a small service, a very important service, but they should rent us more often then if they want recent appraisals.
Можно вопрос?
That is basically, sorry, just to answer, absolutely true. Valuers are providing banks with a value, and then the bankers are deciding how much money they lend on that value. So it's pretty much a loan-to-value decision at the very end. But this is black and white. The reality is pretty much in between these two issues, because we are coming from a time where bankers got valuation reports. I exaggerate a bit, with five pages property description, and then one line, that's the value, and nothing else. And this is not enough, because banks must be able to assess the suitability of the property as a security for the loan. So bankers need much more information than just the value itself, and they must be able to derive loan-to-value, the credit assessment, from really substantial information contained in the valuation report. The report must be substantial, and the valuation must be derived from something. It must be transparent, and the valuer has to assess the marketability of the property. It has to assess suitability for third-party use, in order to learn or to educate the bank in a foreclosure process what could happen. Is there other bidders? Yes. Why? Because there is multi-purpose use possible or not for residential, office, commercial purposes. So banks are eager to know a lot of things which normally valuers, if they are not very educated, do not produce. And this is the whole secret.
Sorry, can I ask?
One moment. Let me address this a little bit, Everett. I think you bring up a very good point, and I think that what needs to happen moving forward is there needs to be better dialogue between the bankers and the valuers. And the type of valuation that is currently done for mortgage lending decisions is a point-in-time valuation. What is the value of the collateral the day that the loan is made? The risk of default on the loan is probably lowest at that very moment, whereas the actual commitment from the bank may be 20 or 30 years. And so, in some instances, I think the bankers are asking the wrong questions, because the appraisal is only one tool in evaluating the collateral that the banks will take for the mortgage. And periodic revaluation may be part of the answer. Trend analysis and valuation may be part of the answer. Again, I think that there needs to be a dialogue between the bankers and the appraisers as to what questions really need to be answered, so that at the end of the day, the bankers can make the decisions that they need to make regarding the collateral risk. Yeah.
I think it's a very good point, more dialogue between client, bank, and the valuer. What we're trying to do at the RICS, we're trying to, we are forcing our valuers in a Red Book valuation to give a statement as to the certainty, I think I mentioned this in my presentation, as to the certainty of the outcome. How is it made up? How many comparable transactions underlie this? What are market trends, Terry, were we referring to? So in this chapter, or in this section, you'd actually bring all these things in. You still derive and deliver a deterministic spot-on value as of a specific date, but you qualify it, because 10 million is not always 10 million. 10 million qualified with a statement on certainty or uncertainty of that result can actually help a lot in the lending process. And I think a lot of things which have gone wrong, and I think the banks are working hard on this, regulators as well, is the lending practice. It's a two-way thing, but I think a statement about certainty of the outcome is very helpful.
I have three short questions to Nikolay Kazansky, if you allow. Question number one. The primary residential market in St. Petersburg, has it cooled down enough in order for us to see growth there? My second question is, what are the drivers behind this growth? I mean, in St. Petersburg specifically, and briefly, if you can, maybe you can give us your own forecast for the years 2013 and 14. Thank you for this question. I will be brief. In terms of growth, I can tell you that starting from the second half of 2010, we've seen, well, if we look globally at market developers of residential real estate, we saw that all the companies that are afloat, and there are about 10 bigger players and smaller companies, they have started to actively buy land plots, because this resource is in deficit, and companies continue to expand their land banks. We saw a year ago when Etalon successfully floated an IPO. They are our biggest developers in St. Petersburg, and this tells us that those who build, they expect that the demand will continue to rise. Every year, 2 or 3 million square meters of residential real estate are commissioned, and taking into account the years of crisis, it turns out that the demand was decreased for some time, then it restored, but the construction didn't begin. And now the prices even grew up a little bit. Prices have become much more stable. They do not go up and down as before. And I talked to leading players, and all of them expect positive development. They do not expect high growth of prices, and the drivers of the growth are like these. There is some stability, yes. We don't have a well-developed system of mortgage lending as in the West, but local residents and buyers from other regions of Russia, they have enough equity in order to buy without getting a mortgage loan. So we have about 20 square meters per capita. In the US, they have 50 or 70 per capita. In Europe, it's 40 to 50 square meters per head. Here, so we are still very much short of residential real estate, and this drives the demand. Did I answer your question? How about the forecast? Well, we are not expecting a sharp increase in prices. We expect stability. We do not think that the prices will go up. The prices will grow, I think, gradually. But since in St. Petersburg we do not have excessive supply, and many projects have been delayed time and again. There are no factors that would disrupt the market, but on the other hand, we do not see any factors that would indicate a tendency towards a sharp growth in demand. So I'm moderately optimistic about the market development. I have two questions, if you allow. Those are questions either to Wolfgang or Martin, maybe, about valuation. Each valuation report is written as of a certain date. The valuer in his report in the West, in Germany, in England, do they give a recommendation as to how long their outcome is going to remain valid? How long this valuation can be used? Are there any, recommendations as to the time frame, or this is just a recommendation by a valuer based on market dynamics? And my second question: in the course of lending against collateral, should the valuer analyze the most effective use of real estate, or the valuer is guided by the current use of this real estate project? Thank you.
The answer is very simple. First, the value provided by the valuer is on the date of the valuation. And the valuer does not provide any recommendation or any information about the evolution of this value over the future. He cannot predict the market, and he cannot predict the value of the property in the future. But the valuer has knowledge of the past, so he can look back and see how the property has performed over the last 10 years, 15 years, if statistics are available. And from this, he can derive some information about the potential performance of the property in the future, not the value, but the property-specific qualities, because he sees how the property has performed in a former crisis, where the value was in the former crisis. And there are good reasons to believe that the property might behave in the same way in future crises, that you can see a bottom line. Then you can say values will not drop below a certain level. But that's it. It is a projection of experience of former crises into the future, but it is not to predict a market, a value of the property. So that is that's I think the first question, and the second was what was the second? Highest and best use. The valuer values the property on the basis of the existing use. And if it is not the most efficient use, it is nevertheless the existing use, and this is the certainty he has, so he has to provide the value on that use. Banks are more curious than that, because banks have always a perspective of, if something goes wrong, the property must be foreclosed, and then other uses might come in as an option where you can sell the property to other users. And this is why this type of background information is very valuable for banks, that they know how the property could be used, alternative uses, but the value is provided on the basis of the existing use.
Can I just maybe add to that? Thank you, Wolfgang. I mean, HBU, highest and best use analysis, should form part of any proper market valuation. The starting point, as Wolfgang has said, is of course always the current use, the existing use, but that can be only a year, 2 years away from a change of use. If there's a 25-year lease with a tenant that just moved in, maybe has put in some tenant improvements himself, the likelihood of actually unleashing additional value of that property is unlikely. But you'd always look at what is the potential alternative use which maximizes the value of that piece of real estate, subject to 3 conditions. Would that alternative use be legally permissible? Planning law comes into this. Would it be technically feasible? There are sites where you can't technically do it. And would the whole thing be economically viable? You know all that. So that's something which, I mean, should form part and parcel of any valuation if the purpose is market value.
Let me build on that just a little bit. The short answer to your question is, how would the market look at that property? And the other comment is that in our country, we've recently introduced the concept of highest and best use over what period of time. And as Martin suggested, a change in use may be probable within a year. It may not be probable for 10 years. But presumably, the market will react to that potential higher and better use that may be coming. And that may be reflected in a change in the capitalization rate. It may be reflected in many other ways. But the market should tell you if that seems to be a higher and better use that is probable in the near future.
Wolfgang, I think this is another one for you. You mentioned the only recent agreement that there needs to be an increase in the Tier 1 amount of capital to 4.5%. Unless I've misunderstood it, there is also an ability for each individual state to apply to the European Commission for an additional capital buffer that they want to put on. I'm just wondering at this early stage whether you've got a feel that every state is going to want to have an additional buffer, and if so, what sort of amount are we talking about in percentage terms on top of the 4.5%?
Yes, we are talking about another 5%. The 4.5 is the legal bottom line. There is another capital buffer called conservation buffer, where all member states in Europe will have to introduce 2.5% additional capital conservation buffer into the system. And on top of this, there is an anti-cyclical capital buffer, which is another 2.5%, but which is at the discretion of member states. So you have 7% mandatory capital requirement, and in addition to this, a variable anti-cyclical capital buffer which can reach 2.5% maximum, but it can be lower. So the range is between 7 and 9.5%.
Let me ask a follow-up question to Peter's question, and this is, I guess, for Wolfgang or anybody here on the panel. Had the more stringent capital requirements been in place several years ago, maybe we could have avoided the crisis that we're in today. However, with these increased capital requirements, some have suggested that they will actually delay the recovery. I know in the United States there's many of the bankers are saying that the government is requiring that they increase their capital reserves at the same time they're asking them to lend more money. It seems to be a contradiction. What are the thoughts of the panelists as to whether this may actually delay the recovery?
I can Just add one thing, and in that debate, of course, the fair value, the market value was questioned, whether this pro-cyclicality of higher capital adequacy requirements plus lend more, come on, lend more, we've given you cheap money from the central bank, plus the mark-to-market of the financial assets and liabilities actually does not sort of make the whole thing collapse. So fair value was under pressure as well.
There is a clear, there's a clear problem. It is not possible to increase the capital requirements from 2. We are coming from 2% minimum capital, and we have to go to 7.5 or even below, beyond 7.5%. And we cannot do this by extending credit lending activities at the same time. For sure, that does not work. But it is a transitional period. We have time for this. We do not have to increase capital from 2 to 7 or beyond in just 1 year. So it's a process starting from next year till 2018. So it's a 6 years exercise, and this will smooth down many problems. But it's a challenge for banks to get additional capital, and that's the daily debate.
Absolutely right that there is a period until 2018 to get the equity, but I think there's the fear that the international investors expect the raise of the equity much faster than 2018. So this could be a problem for all banks, especially for banks that are listed at the stock exchange, so that they have to move faster than the 2018 is in the regulatory. So this could be a problem. And as I mentioned in my speech before, we see this, and on the European market, the raise up from 8 to 9% by the European community has an impact on the lending policy. And we'll see what happens after the 13th of June. So then from this point on, the banks have to have a 9% equity. So let's see. Now, at the moment, they are very restrictive, and we hope that it's getting better when they see and it's clear that they come up to the 9%, and maybe then it's going a little bit smoother and with the lending policy.
Oh, thank you. Any other questions? Yes.
I wanted to check and see, as far as from the panel, the foreign countries, how do you feel about properties like, for instance, I sell churches and I sell racetracks, which are very unique. They're not like an office building. I've got a $7.5 million church that I'm selling to another church. Do you do funding for unique properties? And if you do, how do you evaluate them? What kind of a loan to value would you put on them? For instance, this $7.5 million church has, multiple buildings. It is a current synagogue that's been operating and had great income, but now a new denomination comes in. It's got beautiful land, building, infrastructure. How do you value that in other countries? And the other one would be a racetrack. It has income from the car racing. It's one of those oval racetracks, beautiful land again with it, but how would you look at that kind of an investment, and how would you value that?
I'm possibly not the only one who can answer this. I have to look at Martin, who has probably some ideas. But the more specific a property is, the less lenders can rely on. And what does the lender do? He looks at the credit strength of the borrower. So the collateral aspect is replaced, more specific it becomes, by a pure, the assessment of the borrower himself. And at the very end, we are turning into a project finance. So you will probably find a credit for this kind of transaction if the church has multi-purpose usage. Then the church-specific criteria are not so important. So it is then the question: what is the multi-purpose usage you can provide? And at the very end, project finance means cash flow finance. The bank is not standing on the collateral as a real estate, but the bank is standing on the cash flow produced by this kind of project. And that is project finance, project analysis, and you will find credit for this kind of projects.
I have to say something, otherwise people will say I'm a coward. I haven't valued a church yet, but obviously churches are being traded at times, but they need to be de-designated for the religious use, one thing, and de-designated for a public use, normally, depending on what planning regime you're in, before you can actually think of a third-party use. So I think it very much depends on, I think it was alluded by Wolfgang, what you can do with it, what is the use, can it produce any income, and then can you capitalize the income at a rate which shows the risk and maybe the limited third-party use. But normally there's lots of restrictions in that, and if you're doing this from one religious group to another religious group on the basis of a freehold purchase, so they're going to own or occupy it. Okay. So there's a market. There's comparables.
Well, let me answer the question. This is not directed so much at Dagmar, but the rest of the room, because Dagmar, you're interested in how it's done around the rest of the world. I think it might be useful to talk just a little bit about how it's done in the States. And that is, we do have some lenders in the United States that specialize in financing of religious institutions. That's one thing to say. Secondly, I think alternative financing, meaning bank financing may not be the only alternative that needs to be considered. And secondly, if a traditional bank financing is used, oftentimes the alternative use or highest and best use would be the maximum loan that a lender may consider in a special use property. And then to the racetrack situation, I think as Wolfgang suggested, it becomes more of a cash flow loan or a business loan as opposed to a real estate loan. And oftentimes in the States, the mortgage department of the bank will take a portion of the loan based on a very conservative loan-to-value ratio, and the business side of the lending institution may take an additional piece under a business type loan. Are there any other questions? We're getting close to the appointed hour. I don't want to stand between anybody and their lunch. If there's one more, we'll take it. If not, doesn't appear there is. I would just like to close by thanking our four panelists, Martin, Wolfgang, Michael, and Nikolay. I think it's been very informative, at least for me anyway, and I thank you all for coming.